Welcome to another edition of Inside the Economy. I'm Larry Howes. Thanks for joining me. I'm going to talk about unemployment, U.S. household net worth, which is tied to the country, new home sales. The theme here is the U.S. and the stock market is returning to trend growth. By that I mean we grow according to our income growth. On the stock market side, we grow according to earnings growth. 2024 was a very good year. Yay, there was a lot of froth, there's some really great returns, so on and so forth. That was kind of a different environment. That was an environment where interest rates are coming down and there's a lot of froth and there's adjusting, so on and so forth. That's not going to be 2025. And basically, when you look at the numbers, what we have is manufacturing is okay. ISM numbers are okay. Inflation is very slowly coming down, which suggests that don't be in a hurry assuming the Fed's going to lower rates. It's not in the foreseeable future. Unemployment claims have come up a little tiny bit, not much. It's not necessarily what's going on with the federal government and what the administration might be doing with the federal government. Those numbers are tiny. Well, not if you're a government employee, but in the overall scheme of things, they're pretty tiny. Interest rates everywhere have come down. The yield curve looks better. Mortgages are down below 7. The economy is responding. This is the unemployment numbers. We're trending on unemployment. Number of openings, number of closings. Here are the jobs available. Here's the people looking for jobs. That sort of stuff. It's a good number. We're at 4%. It isn't perfect. 3.5 might be perfect, but the new trend is probably closer to 4 than it is to 3.5. It's not 7 or some of these other numbers back in COVID. It is a good number, and even huge changes in what goes on in the federal government is not going to have a big influence on this. Maybe 4.2, maybe 4.1, maybe. It's not a bad number. It's indicative of a fairly good economy. And you'll hear a lot in the media about, spending in January, just personal consumption just went. Well, it slowed down. They didn't bother to tell you that income continued to climb. In fact, savings rate went up again. We're at 4.6. Consumers simply aren't spending money. It's good. New numbers in credit cards, record numbers in credit cards. Well, most of that is record numbers being inflated numbers. As a ratio, the numbers are actually down. Delinquencies are down. Auto loan delinquencies, even on the lower end of the income spectrum, aren't bad at all. Pretty good shape. In fact, there's a question on this one. What's the U.S. wealth like? It's about 160 trillion. That's more than 2/3 of the rest of the world combined. A lot of that's the S&P 500. Down here on the bottom. Yeah, there's a correlation there. And also housing. Housing market is holding up very nicely. It's 2/3 of the household wealth, by the way, is in the housing, not necessarily the S&P 500. Housing market is holding up, even with the affordability numbers like this, still very high. They're not going to stay there forever. Affordability numbers always come down. It's either from prices dropping or historically it's been interest rates dropping. Right now I couldn't tell you what that might be, but the affordability numbers are not slowing the important thing down. New home sales. There was some stuff in the media about new home sales really dropped down, and you look at this and said, well, they did. But historically, even go back to 2008, the numbers are good. New homes are good. Forget the affordability. People have money to do that, and they're buying new. Well, that's good. New home formation, not necessarily replacement. Multifamily is slowing a little bit, not in Denver, but around the rest of the country it's slowing a little bit because they kind of caught up. The S&P 500 and the other markets, yeah, they've been down. They needed to come down. We've talked about that. They're still not down where they need to be. We need to come down another 6%, and then we'll be there. Then we'll be down with earnings. Then we'll be down where these market valuations ought to be. You're not going to give up everything you made in 2024. You'll give up some of the froth and some of the, boy, isn't this fun? but it needs to come down, and that's exactly what's going to happen. Gee, the rest of the world is doing so much better than the S&P 500. Why is that? Well, it's kind of politically oriented. Here is basically, let's call it Europe, because the European stock market for the last month or so has been doing a lot better. There's the S&P 500 down there in the bottom. And there are, amazingly enough, some of Europe's biggest, most profitable defense contractors. They got the message from the current administration, have their little arguments with just Ukraine, basically saying, well, Europe, I think it's time you take care of your own security problem. Putin is your problem, not the U.S., kind of. That's kind of the message, where we are right now. So, bam. The defense contractors in Europe, oh, they're looking at a lot of new business. Well, yes, they are. New government in Germany is going, yeah, maybe we better have a little deficit spending to get this. You know the rest. The point is it's not that they're more attractive. They were cheaper. They're going to have their own business going because it looks right now that this current administration is not going to keep throwing money at defending NATO. Some issues with Canada and oil, even though oil is down. A lot of issues with Mexico kind of having a deal. But Honda announced, I think their new hybrid sedan, don't quote me on that, I think their new hybrid sedan that they were going to build in Mexico, they went, let's do Indiana. The interest on the so-called debt, meaning the interest paid out to the treasuries, of which everyone watching this owns some treasuries, the cost has gone up. Interest rates have come down, but the actual cost out of pocket from treasuries gone up. Well, that's okay. It's spreading the wealth back. It's not going to be a major source of the federal deficit going forward. Federal deficit right now is the big thing. It's about 7, let's call it 7.5. If it were down about 4, I'd say it was very sustainable and very positive. The administration is going to try to go from 7.5 worth of deficit down to about 4 worth of deficit. They're probably not going to get there. It's not going to be just expenditures alone are not going to get you there. You have to do the income side. Unfortunately, that's a very popular political thing. Oh, more tax cuts, tax reductions, so on and so forth. We need income. The government needs income, needs a little more income, just like everybody else after a inflation period. It needs more income. I hope that there will be some recognition of that. It will help the underlying numbers of the economy fundamentally. We're not going to get there just cutting costs. So, everything else is looking pretty good economically. The U.S. is in great shape. As always, send questions along to info@shjwealthadvisors.com. We're happy to deal with them. And see you next time.